exists that you could sustain a loss of some or all of the money you have invested. Therefore, you should not invest money that you cannot afford to lose. In some cases, it is possible to lose more than your initial investment, as it's not always possible to exit a market at the price you intend upon doing so. And if you don't believe me, just ask a Euro Swiss trader. You should be aware of all the risks associated with investing in the above markets and seek advice from an independent financial advisor if you have any doubts. God, when you look at the mess some of those financial advisors got us into, that's ironic, isn't it? Anyway, the information provided in this webinar is for your general information and use and is not intended to address your particular requirements. In particular, the information does not constitute any form of advice or recommendation and is not intended to be relied upon by users in making or refraining from making any investment decisions. Some listeners might find my language objectionable, so parental guidance is advised. Okay, that is it. I apologize for starting with a disclaimer, but I just wanted to get it out of the way at the outset. Thank you to Cam for introducing me, and thank you to everyone for attending this webinar. I'm very honored that Cam's invited me in to speak, and I'm very happy to speak to you all. Heard of things about me from Cam. It is all true. I am a professional trader. I have been since early 2008. I have worked as a prop trader for several years, but I now trade for myself from my home in North London. Now, I trade two strategies. Okay, now one is a swing trading approach that I trade across multiple asset classes, from Forex to equity indices, commodities, and fixed income. Most of these kind of swing trades are held for the majority of the day, sometimes extending into the next day, very infrequently extending even further than that out to a few days, but that's quite rare. And then in addition to that, I also have a short-term time frame trading approach. That is to say, an approach where I look for smaller moves in the market. I always go into the end of each day flat without exception. And I trade this approach in just one market, okay? And that market is the Bund. Now, since there is normally always someone that says, what in the name of God is a Bund? It's a European 10-year government bond. And here's a free tip. Don't mention the word Bund to anyone that speaks Punjabi. Moving swiftly on, I spent from 2000 to 2007 trying to make it in this game. I started trading in 2000 and I didn't get profitable until the summer of 2007. So that is 7 long years. There's a joke. Successful trading is like getting pregnant. Everyone congratulates you when you manage it, but no one asks you how many times you got fucked first. Well, I spent a long time getting shafted by the market, and I have to say that the experience provided me with much of the foundation that I use to trade today. When we spoke about doing this webinar, Cam said that he was interested in talking about belief systems, why we do what we do, what shapes the way that we act in the market. And I'll tell you one of the key components of my philosophy at the outset, the sort of overarching principle, if you might. And that is that this is a guessing game and you have to watch your risk. Okay. At any one time, you are simply making your best guess on where the market is going to go. In actual fact, you're building a career on the value of your best guess. You are gambling for a living. People don't like to hear that because it makes them doubt whether this is a viable career to pursue. I can tell you that it is, and I'm sure Cam will testify to that too. But for those that are new to this, you have to realize it's going to require one hell of a lot of work, and it's going to require you to make peace with the above statement that this business is a guessing game. Note that I don't say you must understand it. I said you must make peace with it. Okay. It's something that you have to totally come to accept, that you will take losses from time to time. It's just part of the cost of doing business. Is there no sound? I'm just hearing someone say there's no sound. Okay, sound is fine. Sorry. You often hear the phrase high probability. It's now a kind of buzz phrase. So, oh, this trade is high probability, that pattern is high probability. It might be, but you got to remember that high probability is still just probability. As I said at the beginning, I spent a long time losing. So I know how it can affect you. And my philosophy nowadays is to keep the risk small enough so that a string of losers will not upset me psychologically. It's very important in this game to stay energized and to stay hungry. Okay, that's key. You have to stay hungry. You have to come into the market every day willing to play your A game. And the thing is, in this game, there is a kind of sliding scale of emotion. So you sit up in front of your computer screens and you take your first trade and you get a loser. One loser is acceptable. Two losers, it's an inconvenience. Three becomes irritating. Four becomes worrying. Five in a row, it terrifies you. And the thing is, the more you have at risk, the worse it is. Now, over time, you get used to that. Okay, you get used to the fact that once you know your edge, you'll know what to expect. You might know, well, three losers in a row. That's about the extreme of what I get. But when you're new, you don't know that. And you have to go through that scale of emotion. So I always say to people in the beginning, keep your risk low. And I still, I always try to respect this. In actual fact, I just wanted to quickly bring on this table that you can see on the screen. Feel free to take a screenshot of it. This just shows you the probability of seeing a certain number of losers in a 50 trade period. So let's assume that your hit rate, if you look down the side, your strike rate here is 60%, which, believe me, is not that bad. If you can bat 60% strike rate, I'm sure some of you will be able to do better, and there'll be some of you that can't actually get a strike rate as high as that. But let's take 60%. And if you read across, you will see that there is a 70% chance of four losers in a row. Okay. There is nearly a 38% chance of five losers in a row. Okay. You've got just under a 1 in 5 chance here of 6 losers in a row. So, this just gives you a little bit of an idea of what you could experience in this game. But the point I'm trying to make at the outset is that first and foremost for me, it's about understanding and respecting risk. But once that's said and done, how do I actually play the game of trading? Well, I have a way of thinking about this game, and I like to compare it to the game of hot potato. Now, if you haven't heard of this, it's a children's party game in which children pass a piping hot potato to each other around a circle while music plays. Obviously, they're not actually passing a piping hot potato because that'd be extremely dangerous. So, substitute that with a cushion. But basically, once the music stops, whoever is holding the hot potato is out of the game. And it's really fast paced and it's high adrenaline, much like trading. And it's the reason why children love that game. But in essence, if you break it down, the game is really simple. Don't get caught holding the hot potato. Now, the real game of hot potato relies on luck, right? Most of it relies on luck because you don't actually know when the music's going to stop if it's being played correctly. So the only real skill you've got in that game is basically getting rid of the damn potato as quick as humanly possible. But in trading, we're not as much at the mercy of luck. There is a lot more skill involved. There's definitely some luck involved in this profession, but the majority of it is skill. But the premise is still the same as the game, which is that I will take the theoretical potato from someone else and I will hold it for a period of time and I will pass it on to somebody else when I feel that it is least advantageous for them to be taking hold of it. The person that I pass it on to, I like to think of as the greater fool. Okay, that doesn't sound particularly nice, but at the end of the day, we are here to make a living. We are here to profit. And I am going to pass, if I've bought the market, I am going to sell it on to someone at the point when I feel that it's going to stop going up. Okay. Whoever buys it off me, they can be left holding the bag as far as I'm concerned. But that's my job as a trader. And that's what, what you're going to be doing as well. So that's all well and good. But how do I go about working out when it's an advantageous time to take a position and to pass it on? Well, one way is pattern recognition. After years of trading now, and I've been trading 15 years and profitably now for 8, I can tell you that if you study price carefully, you will find that it repeatedly exhibits similar behaviors in certain situations at key times and areas of value. Now, I don't know if you guys have heard of Harris Brumfield. At one time, he was a CEO of Trading Technologies. But I read an interview with him once. And if anybody wants that interview, they can, I have a copy of it on PDF. So you can just drop me an email, I'll send it to you. It's a very insightful interview. And in it, he says, no market pattern repeats exactly the same, but you can see a lot of things developing like they did in the past if your memory is good enough and you remember things that have happened repeatedly. So that's what I do. I look for patterns. I remember how those patterns play out. And when I see them again, I have an expectation. And over time, I can note down probabilities. But whilst it's fair to say that what I do is look for patterns, I don't trade patterns systematically. And I'm going to kind of give you an example of this. So I'm going to pull up a chart here. Can you guys see my chart? Just wanted to check. Hopefully you can. Okay, good. So let's take a basic pattern. And this is a chart at the moment of the US dollar versus the Canadian dollar. The charting package that you see on the screen is market delta, and this is the spot market. Now let's consider a basic pattern, which is what I'll refer to as a swing failure pattern. This is when the market takes out a prior swing point and fails to close through it on the time frame of your choice. You might be seeing that on a weekly chart, a daily chart, an hourly chart. But here is a nice example of it. We get a swing low here, and we have an extreme point, the extreme low. And then you'll see in today's trading session, the market took this out and it probed through that area. It closed firmly back above it. So there was some demand came in down there. The lows were rejected, and we've seen a retracement so far back upwards. So we've undone a fair chunk of this down move. Now, when I've shown the pattern like this to traders before, and I've explained to them that this is a typical pattern that I trade, they'll start going out there and they'll start looking for that everywhere. And the problem is a lot of guys that are newer to this game and they're desperate to get profitable, they take a pattern like that and they break it down into its individual components. So they'll say, okay, so right, it needs a swing and it needs a failure. And once you break it down like that, you find that every swing becomes a location to look for the pattern, and every failure becomes a valid setup. And hey presto, you find yourself taking every single trade out there. You can't blame newer traders for doing this, because when you're learning, you're looking for something that you can visually identify, and obviously you go looking for these, for these setups. But what I want you guys to understand is that for me, this pattern is just a product of the market rising and falling. What is really important here is the story behind the pattern, i.e., why is that pattern being created? Okay. And why do some examples of it work and some examples of it fail dismally? So let's look at the kind of a general thesis behind the pattern, the simplistic thesis behind it. Basically, the theory is that the shorts are trapped in this particular case when we break a swing low and close above. Traders are likely to have sold through the low, and buyers that were perhaps long into the support use sell stops below the low. Okay, so they were expecting that this could be a potential bottom down here, and they bought maybe ahead of it or at it with tight stops and got carted when we traded through it. Both parties are doing different things. You can have one party initiating short down there in line with the momentum as we trade through that area and break a key area of structure. And you can have one party puking, but both are doing their business via the same mechanism of a stop sell order. So it creates a liquidity pool. The professionals know that there are stops underneath these areas, and they can use those liquidity pools to buy into. Now, that's all well and good as a basic, example of what's going on behind the scenes. But if you really want this market to rally in earnest, then ideally what you want is initiative selling through the low. You want traders actively selling to take short positions through that low, and not just traders puking long positions. Okay. So part of my thought process when I'm looking at a pattern like that is have a group of traders specifically got caught. And that's important to me because if you take an example like this dollar Canadian down here, let's assume that there were just stop sells under there from buyers that were preempting a double bottom, and they got taken out. Once those longs have covered, they're absent from the market. They're gone, right? And they've got no more business in that market. But if there's active sellers that have sold down through that low and got caught, then it's a whole different ballgame. Essentially, what I want the sellers providing liquidity to the buyers, and those buyers who then come in and continue buying it back up through the low, so we close above, and then the shorts need to turn into buyers to cover and basically pour more oil on the fire. And generally, when that happens, you will usually see a quick rejection, and it will carry on going, okay? Because nobody wants to get caught with their proverbial pants down, all right? So as people start realizing it's not going to go, they start bailing out en masse. So there's a higher probability that that pattern is going to work, I have found, if we break below, close above, and then we expect to see follow through momentum to the upside relatively quickly. If it hangs around there, it's not such a good sign for me. But the important thing here then that I'm introducing to you is that, okay, we have a pattern that we can look for, but it's the location and the structure of the market that gives that pattern a story behind it. Now, obviously, I can't get into all of this in a 60-minute webinar because I've got an awful lot of things to cover tonight. But some of the things that you can think about when you're even looking at a basic example of a pattern where traders get trapped like that is, will all swings attract the same level of attention? Do all swings attract that level of attention? Take, for example, I'm just going to draw it on, this swing here. Okay. What happens? The market breaks it and closes above, but it doesn't put in a rally. Why not? Is it the case that this swing down here is way more important to the market structure than that swing there? These are the kinds of things that I am considering when I'm looking at a trade. Something else that I'm thinking about is when I'm looking at the swing is, what is the overall trend of the market? If the trend is down, then and we break a key swing low and we fail, we may be more likely to trap traders because there'll be traders that like to trade and chase the momentum, and they'll basically get in line with the trend. And something else that can give me a little bit more conviction is how price moves into that area. There's nothing like a sharp move to raise blood pressure, create excitement, attract traders in. Fast moves like this are likely to entice traders in looking for quick profits. Slow moves, less likely to attract traders into initiating. Okay, if you think about it, and I don't want to dwell on this point for too long, I have covered it in previous webinars, but if you think about it, Even something as relatively simplistic as speed, the speed of which price moves, can make a big difference. Okay, if the market came down into that area slowly, if it drifted down into that area, what would traders be likely to think? They would see this low here and they would think, you know what? This is likely to hold. It's losing momentum coming down into that area, and they're more likely to try and buy it for a potential double bottom support. If it comes into it violently, what are you likely to get? You're likely to have buyers basically shit themselves because they're not going to want to stand in front of a freight train like this. And at the same time, you're going to get sellers thinking, you know what, look at it. It's plummeting and it's about to break this key area of structure. And if it breaks that, it could drop an extra 200 pips, and they come in and they sell the low and they do their ass. So there's a lot of things that I'm just touching on here. But, you know, again, structure, the higher time frame trend is important. The speed of the moves is all really key. Just another quick example of that when I'm talking about higher time frame structure, you might have noticed recently this stitch up in dollar yen. Okay, and what you will see here is you will see a support low, and you will see that that support low got taken out, not by much. We're not talking about a 50 tick plunge through there, but we took it out. We closed above. Look at the strong rejection that we've got here. Now, I'm keeping this very simplistic. I'm not even adding in order flow. I'm keeping it literally with a 60-minute candlestick chart. But I'm just doing that to kind of introduce you to these basics here. And you see the break below, close above. You might be thinking, well, and what? So what's key about that level? Well, let me show you what's key about it. If you know dollar yen, if you're a spot forex trader, you'll probably be aware that there is a pretty big head and shoulders that has emerged on this daily chart. Actually, at the moment, it looks more like the Hunchback of Notre Dame rather than a head and shoulders. But there were a lot of traders looking at this area, and they're going to be getting excited as it plunges through the last support lows on the chart and potentially triggers the neckline. People start to get in, and you see a trap. So the higher time frame there, again, is giving me or providing me with a location. Basically, what I'm trying to do is I'm trying to read the mind of the traders in the market based on what price is indicating they're doing, and I'm trying to trade against them, essentially to identify the weak hands and where traders have been caught at disadvantageous prices. But you do need a story to do this. You need a framework for the decisions you make. It's funny because I sat next to the guy Nav that's been in the media recently that was accused of causing the flash crash. I actually sat next to him. We were at Futex together for a long while, and I once heard someone in the kitchen at Futex asking him how he went about his business, and he answered like a detective. Now, that's actually ironic in light of the fact that he's now at the mercy of detectives, but that's another story. What he meant by that was that he is a detective before he is a trader. He is assimilating a lot of information, and he's putting that information together in order to try and work out what the market is going to do next. He used to say that he liked to sit there quietly at the open, give it some time to trade, wait for the participants to jostle for position in order to then work out what the sentiment was like and what he was going to do next. You see a little bit of that echoed, I guess, in traditional kind of market profile theory with the idea of the initial balance. But this is what I'm trying to do. I'm trying to put a framework over the action. It's always important to know what to look for, okay? Because the market is constantly advertising to you. It's doing that all the time, okay? The market is like one long TV advertisement. It's constantly moving about, trying to auction for buyers and sellers. Now, if you know what you want, then you can resist temptation, and you can only buy or sell when it advertises in an area that you want to do business at. This is what I really like when I've seen Cam's material. It's fantastic because he has a solid framework. He don't just pile in the middle of nowhere. He knows exactly what he wants to see, and he breaks it down into very, very fine detail. I'm sure he's going to mention it in his section of the webinar, but he knows what he wants to see. He knows where he wants to see it and when to engage. And as traders, this is what you need to be able to do. But it's obviously very hard when people have got money burning a hole in their account, and they want to do something, they want to get involved, they want to make some cash, and there are so many advertisements. In the markets, price and time come together to create excitement. If you look for a second at the popularity of selling channels, I don't know if you guys have ever seen these selling channels on the TV. I mean, you find it hard to miss them. They're always on the TV. And they just sell you stuff from morning till night. I mean, it could be a fucking barbecue or diamond ring for the missus. But they often work in the same way, right? And what they do is they use the concept of a fixed price. Okay, so they might start out the diamond ring by telling you what its value is. Its value is £1,000. Okay, and then they rapidly auction that price to a new area, which is the bargain price. So they might say, right, it's £1,000 the value of this. We're starting it off at $99.99. And suddenly it's like, wow, that's a bargain. Why do you think it's a bargain? You only think it's a bargain because you've just been told what the value of it is. Who even knows if that's the value of it? But it's what you've been told. But then what they do is they start a clock ticking on the screen, and you start getting the whole time is running out spiel. You have to act now because there's only 6 minutes left now to get your diamond ring for $99.99. And 1 minute you're sitting in front of the TV with a beer on a Saturday night, and the next you've just bought a disposable lighter repair kit. You've just bought some absolute toot. And the thing is, the market does work in a similar way. It really does. It uses that same concept. Prices auctioning up and down, and often it's doing it very, very rapidly. It's sucking people in at the highs and lows that get excited. And if you fall in the trap of chasing the market, you will end up in the same boat as the person that just buys a load of toot that is just not worth what they paid for it. And if you're forced to sell it on, you would take a loss. So what I'm saying in a roundabout way is you need to know what you're looking for. One of my frameworks is coming back to that concept of value. Where is value? Now, you can spot value on a market profile chart. If I was to bring up a market profile chart here, we'll spot value quick enough. This is a day profile chart for the bunds. And I mark out the value area, high and low, but I lean on a lot of the time the volume value area, high and low. That's what I attach the most importance to. So where 70% of the day's volume has been done. In the bund today, the low is 54.29 and the high is 54.80. See, market delta gives me these green areas, okay, these green lines. So it's a kind of a handy reference to know where value is. But you can kind of spot the value area, maybe not as precisely to the tick, but you can generally spot it on a simple candlestick chart. It's the sideways range, the area where the market is rising and falling, but is largely trendless. This might be on a day chart, it might be on an intraday chart. But the way I see it is there's little to no emotion in the value area. Okay, the value area is the area where the short-term time frame traders, they trade amongst themselves, and it's the comfortable location to trade because there's liquidity, and that's key. There is liquidity in the value area. It's where the volume's done. And if you've ever tried to get out of a big position in a thin market when it's going against you, you will know why traders like liquidity when they're trading big positions. I have seen people firsthand in prop get their arse handed to them when trying to get out of a sizable position in a thin market like the DAX. So the value area is what I call the area with little emotion. Now, it doesn't mean there'll never be any emotion in the value area, but generally this is how I'm framing it in my head. The time that the market becomes susceptible to rising emotion is when we break out of the value area. And it's these moves that kind of create the opportunity. So create the excitement, create the panic. And it's when there's that emotion that you are going to have your trading opportunity. That is the best time to trade, when there is a lot of emotion on the chart. And you don't have to spend too long working out when that emotion's coming in. You can pretty much see it on a day-to-day basis. So, okay, we've got as far as saying when the market breaks out value, it could produce a trade that we'd be looking to take. It would make us sit up and start watching. But then I got to work out whether to go with it or fade it, right? So do I buy it if it's breaking outside of value to the upside? Do I steam in long, or do I trade it back into value? And that's when you've really got to try and judge what is going on. But I'll say one thing: you've got to understand the market is essentially curious. Okay, it's curious and it's temperamental. Just because a market breaks a key support level and it breaks value doesn't mean it's, going to shit itself 500 ticks in a straight line. Sometimes the markets probe below support, probe outside the value, just to test if there is any response from the others in the market. So we might probe through a resistance on the upside to see if there is any further buying. If there is, we'll rally. If there's not, then traders, have got a free rein to take it back into the range. Now, I'm kind of paraphrasing here, but I think it was Dalton in Mind Over Markets that said sometimes markets have to drop to rally, and sometimes markets have to rally to drop. And I think that, if you spend some time, especially as a newer trader, getting to grips with that, which at first, the first time you hear it, sounds maybe a little bit counterintuitive and a little bit confusing, but you will see this happening time and time again. So we could talk about value, but what does it mean? What does value mean? Well, value is dependent on your time frame for a start. Are you looking at a weekly chart? Are you looking at a daily chart? Are you looking at a monthly chart? What might be considered good value in the long term might not be in the short term. Have you ever sold a market only to find that it goes against you 20 ticks, you take a loss, and then it tanks right as you predicted? If you have, and believe me, I've done it enough times, then you've got the right idea but the wrong time. When you sold it, unfortunately, someone has come in and they've perceived that in the short term there's good value in being a buyer, and they've driven it against you until you've ended up puking, and then the longer term trader has pushed it and your idea has come good. So just identifying which direction the market is going to go in is not always enough. You have to identify exactly where and when you're going to get into it. At the same time, what I also want to know when I'm looking at a chart or assessing a market is there potential for reward? Okay. What is my payoff? This is really, really important to me. I'm going to show you some examples of trades in a minute where this is very, very key, because sometimes you will get trades, the potential setups, but there's not really a decent reward in it. I'll give you a very quick example if I can find it. Let me just pull this up. Okay, I don't know where it's gone. It's gone off on one of my screens. We'll forget that for now, temporarily. But it was of the DAX, and if I can find it later on, I'll share it for you. But essentially, the point I'm trying to make is that you are looking on any given trade for a reward, and sometimes even if you've got a setup, the payoff that you're going to get from that is just not worth taking a good trade. So let's break it down now. How do I go about identifying opportunity? It's actually quite simple. It's a simple process. I try to basically frame a bias. So I try to establish where the market is going to go today, principally today. This is what I'm most interested in. So I will assess a weekly and a daily chart and try and work out what the higher time frame participants are doing, where the market is likely to move, and principally when it is likely to move. Is there something on the daily chart that suggests that we might be about to move now? That's key, because it's not just where we're going, is the market looking broadly bullish or bearish, but when we are going to make the move. If you don't get the timing right, it's no good. So I am looking at the higher time frames to try and frame a bias. This is done to essentially give me an idea of how far I'm going to be running my trades. Okay, so this is done really for targeting purposes, because my trigger time frame when I'm trading, say, the bunds, is the 5 minute. So I'll assess the weekly, and then I'll bring the daily. I'll bring it down. I'll have a look at the structure of the market on an hourly, but the 5 minute will be my trigger time frame when I'm focused on that one market. In the example of the bund. Now, the point I'm making is that I don't need to see a daily pattern. I don't need to see something looking really bearish on the daily to be able to trade it intraday. There are good levels that the market trades into on an intraday basis. And you can, I can sometimes get involved and take 10 prices, and I'm completely neutral on a daily time frame. But the reason I assess the weekly and the daily chart is because if I can establish that there is a bias, then that solves the problem of where to get out, what to do once I'm in the trade. Is this going to be a trade where I take 10 prices? Is it going to be a trade where I try and take 50 prices? Is it going to be a trade where I'm going to try and take even more than that? I'm expecting a huge move. So I'm framing what I expect from the market. So that's just done looking at the simple price action. Then I am going through the process of actually mapping my market. Now, mapping the market is relatively straightforward. I'm not going to be able to map a market in its entirety for you now because we simply don't have the time. But I will take my chart. So for example, the bund on a daily basis. And if we just take a quick look at this bund now, I will be drawing in things that are of critical importance to me. For example, this, okay? That's certainly a trend line that you're going to want to have on your charts. At the same time as that, what I'll be doing is I'll be marking out obvious areas that are likely to attract buying or selling interest. Here's a standout one. Key support on the daily time frame here. Key support lows. Okay. Note that it lines up with the S2 pivot, incidentally. But okay, so moving away from that area here, another standout area. This is just simple support and resistance, but can be very, very effective if you know how to use it. So I'm going through that basic map on the higher time frames here. Then I would shift it down to a 60-minute chart. And on a 60-minute chart, the process would start the same, but I would be analyzing the areas that are near to market. Obviously, when I come into the bunds tomorrow, I know volatility's picked up, but I'm not thinking about what, up here. It's too far away, for now. I certainly consider that area, but what I want to be focused on is, where we're trading right now. Is there anything to do here? Incidentally, there is actually, but I'll tell you that in a minute. There was a short-term time frame trade. I think I've missed it. But having a look at this daily, once we're on the 60-minute, we get a little bit more clarity what's going on. You will notice that just beneath the swing lows here, we have a minor, very, very minor area of old structural resistance, okay, coming in around 69s. Those areas are quite interesting to me because there's some confluence there in a little region like that. Now, what I'm doing at the same time is, as doing that, is some of the other tools I use is Fibonacci. I won't get into that tonight. I also use the ATR, and I won't really mention that either. I just have a simple ATR indicator here, so I can put ATR on, and I can see when we've done our, we've gone past our average movement on the day. But one of the things that's key to my mapping of the market is assessing the profile. So having a look at the market profile and seeing what key levels that there are on the profile to do business at. Now, I don't know what's happened to my charts here, because I changed screens earlier, and some of my charts have just they've got that thing where they disappear off screen. So my weekly profile chart has actually just decided to disappear. But I will be, looking at the profile and establishing key areas at which to get involved in. One of the things that I do like to do, and I do like to look at quite closely on a given day, is the prior day's volume value area lows, especially in a situation like today when we've traded down so heavily. So when we come into tomorrow, I might not have a solid bias. Looking at the daily chart, I'm not looking at that and thinking to myself, this is a fantastic buy. I have a support level here, but I don't have a clear long bias. But I'm aware intraday, nonetheless, of some of the more enticing levels that the market could be likely to find some selling coming into. One of which is up here. So you will see that we have significant prior support at 54.29s on the chart. And you'll also see, if you look over to the left, that we've got today's volume value area low. That is a typical area, if we begin to retrace up tomorrow, that sellers will hit it. Okay, sellers will come in there and they will trade an anticipated retracement away from that area. But again, knowing the simple little levels to do business at is only really half the story. If you get in a trade like that, this is where experience comes in. How far do I hold that trade for? Do I hold it for 10 ticks? Do I hold it for 50 ticks? This is the issue. So this is why I'm trying on any given day to consider the higher time frames, consider what the rest of the market is going to be thinking about, and telling myself a story of what is going on. Now, let me give you a little trade example here, and I'll give you an example of basically telling myself a story and how it framed my decision-making process. So basically, this was a trade that I did in the spot euro dollar, okay? And it was based off the 60-minute chart. It was a very quick trade, but the key that I want to impart to you is why I took this, because a lot of people, I sold this area of prior structure, and I took profits at this little high here, okay? So when the market came up into that, if I just put it on a 5-minute chart so you can see what happened, we traded up into that area here, and we sold off very, very quickly. And it was a pretty quick trade. I got sold pretty much the high, covered, not too far beneath that area. But why? Okay, why would I actually do that trade? And what was going on in my head in terms of the story? Why, for example, did I not hold? The euro dollar had a massive rally. So this is where the story comes in. And something that I want to just draw your attention to here is a weekly chart of the euro dollar. Okay, so take a look at this weekly chart here, and we'll put it back on a 60-minute, and we'll see what was going on. Right, now, the euro dollar opens strong, okay? It opens very strong on the day, and it starts surging up. And it's making a very, very strong move to the upside. And we encounter, at this point here, weekly highs. There is solid resistance in this area. There are likely to be sellers coming in ahead of that area with stops beyond it, okay? And potentially traders seeing that massive momentum up there and buying it as well. So you could well get a trap. note what happens that you do get a trap. You get a spike that clears the entire area, and then we get a close below. Now, this is not actually a setup for me, and it comes back to what I was talking about before, that it's an example of a pattern that would be, normally bearish for me, but it's not a setup because of the fact that we've been into that area multiple times. When we consistently knock on the door of an area like that, I don't like to sell it, and we have been up into there a lot of times. But nonetheless, short term, traders are potentially trapped. How does the market react to those traders being trapped? It bails them out. It gives them a free ride, i.e., you get paid for executing what, in my opinion, is a shit trade. It's a shit trade location, but it doesn't matter. There's not much pullback before the market soars higher. So that is the first indication for me that the market is very, very strong. And that if I want to fade that market, and generally I'd like a go with approach, but I'll happily come in and fade it at areas where I perceive there to be little value for buyers. But, and here's the but, I'm framing the expectation that I am not hanging around long in that market. I will be taking very, very quick profits. If I was with that move, then I would be trying to run it, but I'm not. So what we do is we surge up into an area, we trade way past ATR. This is pre-FOMC, and we trade into prior structure. Now, structure like this is likely to hold the market back, at least temporarily. But when we are coming into key event risk, and when we are so heavily up on the day, it is likely there that the probability shifts to the fact that we are going to pause, that we are going to take a breather. And so that is, I get a little pullback and I'm out of the trade. Now, that's why I took that trade, but I just pull this up for one more thing just to mention about this. If I go back to it. Okay. This is why trading is so hard. This here is why trading is so hard. This movement that the market makes. Because if you are not looking for a small move there, if you're looking for a bigger move, the market makes it very difficult to capitalize on that. Why? Because initially, where you sell it, you nail the market bang on. Okay, you get pretty much zero drawdown, and the market trades into profit. But then what? Then you come up, and okay, this is a 5-minute chart, but it doesn't look much prettier on the hourly. The market then takes out the sell point. This point you sold it at, you're now underwater, and you close, that 5-minute out offside. We then come back. Maybe it's about to go now. No, it drives to a high for a third time, and now you're significantly offside. And it's points like these where traders are forced to throw in the towel. Okay. And then, unfortunately, they then come in and they look at it afterwards and go, oh my God, look, it's gone down as I expected. But it's this movement that makes it so difficult for traders. It's the constant second guessing. I'm into profit, now I'm offside, into profit, offside. So, the only reason that I got a winner out of that trade is because I was aware that I wasn't going to be hanging around. And the story that the market had been telling me on that day suggested do not hang around because, and this is key, the market was given a green light to sell off and it couldn't do it. So it had a chance to sell off and it just couldn't go. And that's really, really key for me to take something on board like that. Now, there's one more thing that I wanted to go over. I'm aware that I've probably talked for almost an hour now. I just wanted to tell you a little bit about how I prepare for each day. So we've had a look at the market mapping, the support and resistance that I draw. I look at the market profile. Of course, I'm not going into too much detail in that, but when I'm looking at the profile, I'm certainly considering volume value area highs and lows on a weekly composite and on a daily market profile chart. And of course, I'm also looking a lot at single prints, okay, on weekly and daily charts, where the market went from a balance phase to an imbalance phase. That is really key for me. to look at those areas. Because, again, when the market trades back to these areas, you do often see it trade away from them in the short term. But when it comes to preparing each day, this is really vital. In fact, the situation that I go through each day is probably more important than actually what I do, because obviously everyone, not everyone is going to be trading in exactly the same way as I do. But I believe that you can do very, very well by getting yourself in a kind of a regimented routine. So what I'm doing is, when I'm basically preparing for my trading day, I have a plan of what exactly I am going to be doing. I know my setups, as it were, very, very well. If I just bring something onto the screen now, this might surprise you. I'll keep it zoomed out so you can't really read it, but what it says doesn't matter. This is my plan from start to finish. So the actual intricacies of it are less important than the fact that this is a visual diagram of my entire plan. Now, the way I've broken it down is, what I have done is, every move that the market makes, I have a step, a process that I can go through. So if I zoom in on a particular section of it, let's say, let's have a little look here. Okay. So for example, here at this section here, I have a question: how strong is the level that I'm looking at? And I can grade the level in terms of strength, okay, considering these factors over here. And when I grade the level, depending on the strength of the level, I have another response from me. If the level is very strong, I will enter an order for a blind touch trade. That means I will literally sit on the bid or sit on the offer. If the level is not that strong, then usually I'm going to need a factor of confluence, another reason to take that level. And in some cases where I do like the level intraday, but again, it's on the weak side and I'm not wholly convinced, I will look to see if order flow corroborates the level, i.e. if I see something happening at my level. So I might be looking to buy below market and I'm not totally convinced by the level, but I've got it marked out and I'm watching the DOM and I see a lot of absorption. I see sellers hitting into a big buyer who just sits there, he reloads the bid, and I think to myself, right, there is somebody is buying that here. They have confirmed what I saw. And on trades like that, I will often get involved. But again, there is a difference between the kind of trades where I am literally going to just get on the bid at key levels ahead of time, and areas where I would wait for a little bit more confirmation. But each day I come in and I first off look at my charts, make sure I've got my markets mapped, work out key areas to do business. But then I also try to assess the sentiment of the day. I read a lot and I also scan Twitter. I use Twitter avidly, and not just to talk a lot of shit, but I actually watch it. And I watch what people are saying, because this is the market. This is the market here. And I'm interested in what people are saying. Now, a lot of people don't use Twitter because they say there's noise. There's too much noise on it. There is a lot of noise, but I'm interested in that noise and I filter it. I'm not interested in what everybody has to say, but there are certain things that I am looking at to try and gauge, what does the majority of people seem to be expecting? Aha, is it every time I look, everybody's going on about this head and shoulders in dollar yen? Right, so I better focus on the neckline and I better see what happens there, because if there's a stitch up, we could get a very sharp counter move to trap the shorts if the neckline breaks and there's no follow through. So things like that are important for me. what I do is, as I'm planning my day, I utilize this. Feel free to screenshot it. But what I do here is I write down everything. And the reason I write down everything is so that when I get to the end of the day, I am able to check back and see if I did what I was supposed to have done, i.e., did I keep to my plan? So you can see that this plan is nothing to do with the visual plan that I just showed you in terms of the flow chart. That just shows me whether a setup can be traded. That is my process. That is my framework. This is where I am simply writing it down. I am writing down what figures are coming out today, so I don't get caught, I don't forget that it's retail sales at 9:30 and get long cable, at 27 minutes past 9. Where are my levels? Where am I doing business in the Bund on the upside today? Where am I doing business on the downside? Write it down. If I have an expectation for the day, I'll frame it here. So what kind of day am I expecting? Let's say it's a Monday. There's a lack of major tier 1 data today, and Friday was a big wide range day. Maybe Monday, I'm likely under that scenario to expect a neutral day. Okay, I'll try and sell above value, buy below value in a situation like that. Or maybe Friday, we got a huge bearish engulfing. There's a lot of levels above market. There was a very bearish tone in the market Friday. And I'm going to come in and I'm going to sell Friday's volume value area low on Monday morning. Little things like that. Now, it's hard for me to give you every example ahead of time, but, this is what essentially I try and do on Twitter. So if you get any questions about, what am I looking at, feel free to shoot them over to me and I'll ask you and I'll answer you. But this is the kind of thing that I'm doing on a daily basis. So I have that plan, and I have it written down. The final thing that I'd like to end on by saying is I always monitor myself during the day to make sure that I'm not susceptible to negativity. What do I mean by negativity? I mean those emotions you get when you get your ass kicked, when you buy the high. It is going to happen from time to time. To be honest, I can't remember the last time I bought the high tick, but it does happen from time to time, or when you puke the low tick. And it's very, very frustrating. And sometimes it can happen a couple of times in a row. It's my job to make sure that I don't get affected by that I can take the third trade with no negativity, with no attachment to the prior two trades. Okay, that is my business, to ensure that I can do that. You always have to work on yourself constantly in this arena. If you're not working on your edge and you're not working on your mental game, someone else is, and they will beat you. That's the bottom line. I don't know if Cam would corroborate this, but I'll tell you something. When I was in prop, you would see a lot of grads come in to trade. And in prop, those grads would get the same education and training. They would get given the same risk parameters, i.e., you're only allowed to lose 400 euros a day with a 10-lot limit, or what have you. They're all given the same broker. They're all given the same software and the same order entry tools. They've all got access to the same squawks, and they have the same commissions. And then the grads have the same capital, so no one can trade larger than anyone else. Essentially, the playing field is really leveled out. A lot of what you hear in the retail sphere, like, oh shit, if I had 4 screens, I'd be a whole lot better. It's so unfair I don't. Or if only I had 5 grand in my trading account, I'd be able to trade a lot better. But unfortunately, I've only got 500. It's leveled out in prop. But the fact of the matter is, still only 10% tops make it and end up staying in prop and becoming a professional trader. The other 90% fall by the wayside. Why is that? If the ground is leveled out in terms of even their training, why is that? And I think the bottom line is psychology. It's how you approach this business. Again, if you're not working on yourself, then someone else is putting in that work, that effort. They will survive and they will take your hard-earned money off you. So if you take one thing away from this presentation, then make it this, which is when you come in tomorrow, when you come in the day after, when you come in next week and you sit down in front of your computer, you need to play your A game or there's no point turning up. And that is in the forefront of my mind every single day, to stay focused, to stay disciplined, to stay on top of my game. Now, again, I haven't really delved into a whole lot of strategy tonight. I know Cam wanted to keep it a little bit more on, belief structures and how we go about approaching the day. I will be very happy to do more webinars in future and exactly how I go about trading if you've enjoyed this one. But at this stage, I'd really like to say thank you to Cam for inviting me to speak with you guys. And I'd like to wish you all the best with your trading. And I'm very interested myself to, as Cam is similar to myself in, as he said at the beginning, I'm very interested to hear his presentation now, and apologize for having gone a little bit over time.
Hi, thank you very much, Tom. That was brilliant. You just delivered on exactly what I thought you would. You hit home with many concepts. I've actually been sitting here making notes, and I'm going to discuss these concepts, these ideas that you've already discussed, and I'm going to, build upon them and sort of add my own little flavor on top. But thank you very much, Tom. I think you've done an excellent job, and I'm sure everybody else will agree. And if you guys are still okay to hang around, I've got about an hour, and I'm going to share some good shit. I'm going to share some good stuff, and I'll make it worth your while. But, if you've got to piss off somewhere, just watch the recording. I'm going to carry on right now. But thank you very much, Tom. If you've got any more to add, let me know. Otherwise, I want to get straight into this. Okay, Tom, that's good. All right, guys. So I just want to take a moment to share my screen. Just give me a moment. Okay, let me just do a quick sound check and a screen check. Make sure you guys can see this. See this okay? Yep, all good. All right. So what I'm going to talk about today is about more so the philosophy and the process. The thing is, what I found in trading and trading education in general, I've been doing this for like 10 years now, coaching and teaching traders. But what I found is I've been guilty of doing the same thing, because what everyone does is they try to talk about the technicals, the setups, etc. But the issue is not there. The issue has always been mindset, understanding, your level of understanding of what you're looking at. If you're trading discretionary as an auction market theory profile trader and you're making choices and decisions, you have to understand what you're looking at. You have to understand from a point of perspective that you actually have confidence. You believe in what you understand. You actually believe what you are trying to practice. It's pointless trying to practice something you don't believe in. So you have to sort of take on ideas that sort of make common sense. They just make sense in everyday living. That's why auction market theory makes sense. Profile trading makes sense if you understand it in a certain way. And what I've done with the trading framework is broken down what I have used over the years, because I didn't firstly start with auction market theory or profile trading. I didn't start with order flow. So there is this misconception that people start to believe that if you're using market profile, auction market theory, order flow, the market delta footprints, that must be where the magic is. That must be where the answer is. And it couldn't be further from the truth. The answer is in the process. Tom had just proven to me what I believed. I had no idea what he was going to present, but I specifically asked him to focus on the mindset rather than the technicals. And the reason is because I want you guys to recognize we're two different traders. We are very similar in the fact that we're a similar age. We have a similar sort of background. We trading with some background in prop trading, but we also now trade our own accounts. He also trades a Bund. I trade the Bund. He trades currencies. I've got back into the currencies recently. And the thing is, there is a lot of similarity. It's the first time I listened to Tom for about 10, 15 minutes. And I realized this guy, he is basically just talking from experience. You can just tell the difference. So that's why I got Tom on board, because I thought, I just know ahead of time that he's going to be very similar to myself, and we're going to teach very similar sort of concepts. So what I want you guys to do right now, as I said a little while ago in the chat box, I said, look, don't focus on the technicals. Focus on the mindset here. Start to get into our minds. Start to get into our thought process, right? Because that's where the answers are, right? Every Tom, Dick, and Harry, sooner or later, is going to be using auction market theory, market profile, order flow, right? That's not where the answers are. If you haven't got a certain way of looking into the markets, a certain process, it's all pretty useless. So I want you guys to start looking for answers elsewhere. The answers are not in the tools. The answers are in the understanding of the marketplace, and then applying them tools within context, story, understanding the story of the marketplace, believing in that story, right? So quickly got to get through the disclaimer. I do not have any knowledge of the trading needs, objectives of individuals of the presentation. This presentation represents suggestions, training, and information for viewers to use when evaluating and making trading decisions in light of their own individual trading goals, and does not constitute specific advice. I apologize, guys, but I'm a bit bunged up. I'm under the weather. I've got a bit of a cold, so I'm just soldiering on. I do not take into account the trading objectives, financial situation, needs of any particular person, and before making a trading decision on the basis of my analysis, the prospective trader needs to consider with or without the assistance of an advisor whether the advice appropriate in light of their own particular trading needs, objectives, financial circumstances. Trading the future market involves risk, revenue can be gained, expense may be accumulated. So let's get into the philosophy. So firstly, we don't trade systems or strategies. Contrary to the belief, right? We don't actually trade systems or strategies. Even if you become a mechanical trader, somebody that trades every signal from a system, you are automatically going to experience some kind of discomfort, some kind of conflict, because as a human being, you're not a robot. You're not supposed to function that way. So you're going to have certain feelings, especially with experience. You're going to realize certain things just don't make sense. You're going to get a long signal and you can look at the market and say that just doesn't make any sense. So basically, with discretionary trading, you can't do anything else. You have to trade your beliefs and opinions. So that's going to be different for each and every single one of us, right? So whilst we use the same tools, we will build different plans. We will have different support and resistance, etc. Right? Every now and again, it might sort of align, but you've got to start believing in what you see. You don't want to use somebody else's support and resistance, not knowing why it makes sense. It's all about making sense of what you see. You can't do business in any endeavor if you can't make sense of the marketplace you're in, right? So perception is projection. The idea here is that what you perceive is filtered through your perception. I'm a neuro-linguistic programming practitioner. I'm certified, a master practitioner actually since 2006. And basically NLP teaches that we filter our perception, our experience of the environment. So we all look at the same market and we see it in a different way. Why? Because we delete, distort, and generalize that information to make it fit our model, our way of looking at the markets or life in general. So we filter subconsciously, unconsciously, through our beliefs, our values, our memories, past experiences, and everything else. In a split second, we filter everything. And so straight away, as soon as you see something, it becomes very personal, because you cannot see something without it being a projection of who you are and what you believe. It's impossible. So the objective becomes to really, truly believe in what you see, really, truly understand what you're looking at. Because without that, discipline, patience, all of them things we're looking for, they are impossible. So you have to believe in what you're seeing. You can't just copy other people. You have to get into the mindset. You have to get into the thought process. So this is the philosophy of the trading framework. Building beliefs that are common sense is essential, in my opinion. And that's why I like auction market theory. I like market profile. It just makes sense because we use these principles in everyday living. You know, when something's cheap, we like to buy it. We don't want to sell it at lower prices. When something's more expensive, we like to sell it. We don't want to buy it at overly priced offers. We want to buy at advantageous prices, which is when it's below what it's worth. We want to sell at higher prices. That's auction market theory in a nutshell. In one or two sentences there. That's it. It's that simple. So we need to focus on reading the mind of the market, not just price patterns. So when we look at the charts, don't just see candlesticks. Don't just see bar charts. Don't just see market profiles. Ask yourself, what is this market thinking? When you look at your charts, think people. I am basically looking at people. You are looking at people. You are looking at their thoughts, their beliefs, their opinions of the marketplace. You know, I quite often say you need to become much more of a psychologist rather than a mathematician. So when you look at the markets, especially the way that I look at it, and I'm sure very similar to what Tom does as well, is that you need to sort of become a psychologist. You need to always be asking questions. What is the market trying to do? What is it trying to achieve? What has it done so far, etc.? So you're trying to read the mind of the market. Don't just look for patterns. Don't just say, look, oh, there's a head and shoulders, let's buy. You know, there's a break of a neckline, let's just, you know, short. There's support, let's start looking at the order flow for long. Because with that mentality, it's not going to make any sense. You're not going to really get there. If it was that easy, it would be great because it'd be easy to teach, but it's not. It requires a deeper level of understanding. You have to understand, you know, if you try to break it down into setups and like rules, it's just not going to happen because the markets are not fixed. The markets are dynamic, living, breathing organisms, right? And they're changing all the time. You know, the volatility we see this week is different to last week. Every day it changes. So they're living, breathing organisms. There are similarities in their nature. There is a harmony. There is a harmonic nature to every market, but it is a living, breathing organism. You can't trade the markets effectively with fixed parameters. It's that simple. So what I tend to do is I tend to focus on finding value and trading with a perception of where value is, because that makes sense to me. If I understand how much a market is worth or what I believe it's worth, I know with confidence I can focus on buying or selling that market depending on where it is. So for example, if it's above value, I will focus on shorts. If it's below value, I will focus on longs. Does that mean the market can't move lower, below value or higher above value? Of course it can. You know, today was a prime example. I'm going to show you that because I talk about the psychology here. The psychology is people are going to get sucked into selling into those lows because they don't see the bigger picture. They lose sight of the bigger picture. They get sucked into the short-term picture. And that's what many of you are actually doing. I see it time and time again. So as Tom said, we need to break down the market action into context. We have to tell ourselves a story. We really have to understand what we're looking at. You know, it has to make sense. And that story is a personal thing. You know, when I do my pre-market analysis, I always say, look, this is my analysis. This is my story. It's not yours. You know, use it how you wish, but please keep in mind, you need to do your own homework. You need to do your own analysis because it needs to come from you. Because belief and confidence, I'm sorry, it can't come from somebody else's analysis. If you've not taken the time to understand the market, the doubt and the fear will take over. It's just a matter of time, you know, because you don't truly understand the situation. You have to understand context. You have to understand story. You have to. It's not a question of whether you can or you shouldn't. You just have to. So I tend to focus on grade A trades only, not any old crap. The market's going to be moving all day long. I'm trading intraday. There's going to be lots and lots of swings. Yesterday I was long on the Euro stocks. The bigger move was down. Today, my first trade didn't work out. I got stopped out. Next trade, I made a little bit of it back. I still ended up down a little bit today. But, I waited for the right opportunity. I had confidence in it. It was a grade A trade. So I have done all I could really to put all the odds in my favor, with belief and confidence. I basically can look at that situation and say, look, I've waited for exactly what I wanted to look for. It made sense. I had belief and confidence in that situation. I took the risk. And that way I can accept if it doesn't work out. I explained that today. If you sit there and take any old crap trades, grade B, grade C trades all day long, of course you're going to struggle with accepting that loss because you already made a mistake. Whether you admit it to yourself or not, that's another story. But if you really, truly understand, you have to be honest with yourself. If you're taking grade A trades only, right, on a consistent basis, you should believe in them. You will not allow doubt, fear, and anxiety to take over, okay? So one of the things I spoke about today, market is an illusionist, all right? Sorry about the typo there, guys. Market is an illusionist, so it's a magician, basically. So what we will find is a market, let's look at today's action. The market will look like it's made a lower low and then a higher low. It's the E-mini S&P. And at that point in time, when that pullback happens, let's forget the fact that this new bounce has happened. But if you look at that situation, before that break of that high, if I just get back to the chart. Sorry about that. Okay, so here we are. So just imagine, we don't know this market's going to break that high. Okay, we see it as a lower high. It's a bounce. Automatically, people think continuation, right? Without context, that's what sort of makes sense. But with context, it's a completely different story. Now, the point is, the market will make it look like a good short when it's not. It will make it look like a good long when it's not, if you have tunnel vision. But if you have an understanding of context, you understand where you are from a bigger picture perspective, you can sort of regain that understanding of context. You can sort of gain an understanding of where you should be focusing. So yes, you're going to miss some moves with this, this approach. But the fact is, intraday, there's too much opportunity. That's what it is, right? So we need to focus on the smart money. The smart money is the banks, the hedge funds. They move the markets. We don't. I trade some decent size, but not that big. When I was trading prop, I'd go like 30, 40 contracts with scalps in and out on a consistent basis. But I got too big, too heavy, way too soon in 2005, 2006, and I had to learn that. I had to drop down my size, had to start trading 4 contracts again on the DAX. I didn't actually move to 20 contracts until September 2011. And then I had to slowly scale up. Then the Euro stocks changed its nature. I started trading the Bund. And, whilst now I trade some decent size, it's not that big. I'm not going to move the market, basically. So most prop traders are very short term. That's just the way it goes. Most prop traders trade, scalps, very, very short term. I'm not talking about the majority. I'm not talking about everyone here. I'm talking about the majority, right? So the smart money is the banks, the hedge funds. This is where the cash flow comes. This is what really makes the markets move. We're not going to make that happen. They typically focus on the long term. They don't focus on the short term. So these are beliefs, right? This is not the truth. There is no such thing as a truth in the marketplace. These are all beliefs. These are all things that I've decided to believe in. And no matter what, I'm going to stick with. I'm going to believe in it no matter what, because it's proven the test of time, right? So these are beliefs. The philosophy here is a belief system. It's a belief structure. You can believe what you like, but at the end of the day, if you believe it, you've got to truly believe it, because otherwise the doubt, fear, and anxiety will take over. So you have to truly believe in your philosophy for trading the markets, the way you trade the markets. It has to make sense. right? So what I believe is the herd typically focuses on very short-term moves. They have a very short-term focus. They see a short-term intraday downtrend like today, and they're basically going to jump on top of that. So yes, every now and again they're going to profit from that, and the move will continue lower. Now, Tom spoke about this a little bit earlier, and it confirmed what I was talking about. The head fakes, selling below the lows and buying above the highs. And the point is, even though we're different, the process is very similar. We have a very similar mindset, and that's the point of this whole webinar. There is a process for placing the markets into context, providing some kind of story, right? So, as Tom said earlier, you can have the right idea, but at the wrong time. Okay, so I also have a very similar approach to Tom. We have a top-down analysis perspective. He then looks for which moves to focus on, and then he looks at engaging. And I have a very similar process for timing and execution. I plan, prepare. I have pre-engagement scenarios, which is basically longer-term perspectives, things that I'm thinking about getting involved in. I know I'm going to be focusing on the buy side, for example, below wider value. But then I have an engagement scenario, which is the next step. I've got a whole webinar on this. I'm not going to go into that right now, but because that's timing and execution. So, as I said earlier, there is too much opportunity in day trading. The market will make lots and lots of moves intraday, especially under volatile situations like we've seen, over the last few days. Actually, going back to the sort of beginning of last week, maybe the week before as well. Especially the stock indexes. The Bund has all of a sudden woken up. And funnily enough, the Bund has made these massive moves. I've not been able to trade it because it's not set up in alignment with my plan. And that's supposed to be my main market. That's just the way it goes. So you have to specialize. I specialize in trading value. Tom spoke about value as well, which is, again, a similarity between, the ways we think. We're two different traders, but we put the market into context. We understand the story. We understand where value is. So specializing in trading value is a central part of the trading framework that I teach. And focus is essential because intraday you can really easily lose yourself. You can lose yourself because there is opportunity everywhere. Every low volume area is a potential rejection point on a profile, right? So every time we get below value could potentially be a buying opportunity. Every time we get above value could be a selling opportunity, but it's not. It might be a shit trading opportunity, but it's not a good one. You then have to become more specific to find the better opportunities, the grade A opportunities. So risk management with position sizing and dynamic trade management parameters can also help enhance your performance over time. And next point, trading is a lifestyle. What you do for your 3 or 4 hours or 8 hours or 10 hours, however long you trade, it's a lifestyle. You got to practice being disciplined and patient in life. It's not just about doing that in your trading, because look, if you're a lazy fucker and you can't get up on time to get into the markets, or you can't build your business plan, your trading plan, and do your pre-market analysis for the day, you haven't got a chance. As Tom said, the competition that you're up against, they are willing to do so, like me and him, right? So trading is a lifestyle, and you have to live that lifestyle. You can't have a half-assed approach. You have to put your full commitment, dedication into it. You have to live, breathe, and sleep your trading. You have to, for me, I meditate every morning, every evening, without a doubt. I have to learn to let go. I have to clear my mind. I then do my pre-market analysis. I have rituals. I have routines that I follow, right? So the process, technical stuff now. I'm going to break down into this. Give me 1 second, guys. Okay, so I've got some questions coming through, but I'm going to take the questions a little bit later. Okay, so please hang on. So my process, and that's what I want to focus on. I don't want to talk about setups. I want to talk about process, because the process is a guideline. It's a journey. It's a path towards an opportunity. Whereas when you break down setups into like specific rules, like this, and this happens, I got to buy. You know, like for example, if you was to say every low volume node or low volume area below value, I buy, you're not going to get anywhere. It sort of makes sense with structure, and a newbie trader would do that. But it's not going to be good enough. It has to be more defined. So the process for myself and what I call the trading framework, this is this is a reflection, I suppose, of my whole journey. It's what I've learned. This is the product right now. This is what I can put it all into. You know, I have not only grown as a trader, but also as a coach and a teacher. And I don't hear many people teaching the process. They talk about the technicals, but people don't get it. Why? Because people don't understand there's a process, there's a mindset. That's what you got to get. Right? The technicals are a byproduct of that. If you don't understand the process, you don't believe in what you're looking at, you don't understand what you're looking at, it's useless. You know? So this is the whole point here. And that's why I brought Tom on board, because I wanted him to share his mindset. I want to share my mindset. Whilst we might trade in a different way, we're two different people, we have a similar mindset, similar process, because he spoke about a top-down approach. He spoke about grading trades. He spoke about having a vision, a plan. He said a market map. I call it a vision for the day. It's the same thing, but we just labeled it different things. So funnily enough, we ended up coming up with a similar process, but explained it in a different way. And that was the whole objective of this webinar. So the process for me is find a sideways balanced market phase, which is basically where value is. That's what it is. I then draw a custom volume profile around that range. And then I understand that's where value is. That's where I'm going to focus on trading towards. Okay. Now I'm going to oversimplify this. I can't teach you my whole strategy in, a few minutes here. But what I want you to understand is the basics. There's a process to this. I'm putting the market into context. I understand what it means. So I then use a composite profile to highlight low volume nodes, low volume areas above and below the range that I've defined. So I'm going to move on from that. And what you'll notice here is the E-mini S&P. Okay, I don't want to get too much into the technicals, right? Because there is actually a whole presentation on the concepts that make up the trading framework, what I call the trading framework. Please keep in mind, this is not traditional auction market 3 profile trading. I have made this my own. There are certain concepts that are a part of this that are not really a part of traditional market auction market theory, market profile trading stuff. Right? So I use traditional bar charts, candlestick charts, and I highlight when the market's sideways. Really, really simple. And as soon as I find that, as soon as I recognize that, I draw a profile around this range. Now, this has already been here since the beginning of April. And, I'm not making this up. It's been there for a while. As soon as the market does this, and this, that's a sideways range. Basically 80 to 120% retracement of a prior swing. That's all it is, right? That's 100%. This is 120%. This is 100% into this low. Basic stuff. It's just basically a sideways market. As soon as I see that, I draw a custom profile, and I'm using market delta here, around this range, and I find where value is. Now that becomes my focus. I want to trade back to that. On the right-hand side, I have composite profile. That will go back a good few years or a few months. In this case, it goes all the way back to June 2013 on the E-mini S&P. So what I've got here now is acceptance and rejection, right? If anybody's new to auction market theory or profiles, basically the bulges are acceptance. That's where the market wanted to trade. That's where it actually was interested in trading. That's where the market facilitated trade. Let's not forget here, the job of every market is to facilitate trade. Nothing more, nothing less. The market wants to facilitate trade. It wants to bring in people to do business. It does it best, and it proves it time and time again, when it finds value. And how is it proven? Because most of the volume trades within value. The value area defines where 70% of the volume traded. So that's where the majority traded. Now, here's the kicker. The majority trade in the worst part of the market context. They typically trade where the market is likely to chop within value. Think about day-to-day living. When you go shopping, if you're a retail store and you buy a product rather than at wholesale, you buy it at recommended retail price, are you going to make a profit if you sell it again at recommended retail price? You're not, right? So the market, to buy it within value and sell it within value, especially around the fairest price, the VPOC, the volume point of control, it just doesn't make sense. So the opportunity becomes below and above value, and that's a belief we have to take on, with the trading framework. So what I highlight here is, you can see I've got green lines, I've got red lines. Below value today, for example, and yes, it has continued to sell off, but there was a very significant move higher and a very decent opportunity towards the upside. And I still would anticipate a move back higher, because this is just below value. It's having a test below value because it doesn't know what else is there. So of course the market has to negotiate price. It has to get below this low to see what's there. It has to get close to this low to see what's there, because it was there a while ago, but now it wants to test it again. That's a negotiation process. So what we see is these breaks of highs and lows very consistently above and below value. And that's where the Fibonacci retracement extensions come in, right? Now, these are something that a lot of people will say, well, what's that got to do with auction market theory? It's about pricing, guys. It's about pricing. This is a swing high to the low that I've already taken. And in this case, the 161.8 extension held above value. And not only is it about pricing, it's about harmonics. The markets have harmony. They have rhythm, right? They make similar moves again and again and again. There is symmetry. The harmonics with Fibonacci is there. I mean, I've been using Fibonacci way before auction market theory profile trading concept. So I still use them. There is this bullshit about like moving averages don't work, Fibonacci doesn't work, pivot points don't work, this doesn't work, stochastic, MAC, you name it, right? This just comes from people that can't make something work. They can't put it into context. If you put something into context, I give this challenge to people all the time. I say, give me any chart with any indicators on it. I will make sense of it. I will put it into context. I will understand what that market's trying to do, right? Without even using profiles. I can do that with confidence. So you need to be able to do that. Can you look at a chart without any tools, indicators, and actually understand what the fuck is going on? You need to be able to do that. That's sort of an absolute minimum that you should be able to do. So back to the slides. So after we found the value area, as I've just said, we use Fibonacci retracement extensions. I'm not going to go into that too much because this is not about the technicals, it's about the process. So I draw them because I want to measure how far can this market get above value? How far can it get below value? And when should I give up on buying below value and selling above value? Yes, I want to short above value. Yes, I want to buy below value. But the market's not always going to find resistance above value and support below value. So where do I give up? And that's where the Fibonacci retracement extensions provide the answer. That's why I call it the trading framework. So I also do this on markets with confluence. Like I don't trade the bund without the bubble. Okay. Now, if we look at the bund and the bubble right now, there is a massive low volume area here on the bund. Bund is on the left, by the way. The bubble is on the right. Okay. And we've just been dropping off, but we've come into prior value. To the left, look on the bund. On the bubble, look to the left. Prior value. That's where we had value. We found value. We traded around it for a good few weeks before we moved away. We're back into it. So the market must be thinking, okay, well, we couldn't find value higher. Let's see if we got value down here. This is a memory in the marketplace. The market has a memory. This is the mind of the market. It's going to test around this area until it proves that it no longer finds value. So typically what you will find is a new value area. I would anticipate for example, over the next few days that this market will move sideways around this range. Okay. I could be totally wrong about that, but I understand why. I understand why I believe that, because firstly, there's a massive low volume area below here on the bund and the bubble, which is a rejection area. There is acceptance above us, which is where the market actually wants to trade, funnily enough, because that's where it accepted, that's where it traded, because it must have wanted to trade there. So the low volume areas actually provide the opportunity. They are our support. They are our resistance. So we should expect the market to go from rejection, low volume areas on the profiles, to high volume areas. We use value for that. We use composite profiling. But I'm not just using tools here because somebody said, oh, low volume nodes and low volume areas are support and resistance. I actually understand what they mean. I understand that that is rejection. I understand that the value area highlights acceptance. I understand the market will want to gravitate towards where the market facilitates trade because that's its purpose. Right? Hopefully that makes sense. So above and below value, I then have the areas. I then go to short-term charts. I visualize what am I going to look for next. I'm not going to just buy every support level or every resistance level. I have to visualize what kind of scenario do I need to see here. Does this market need to bottom out? Does it need to top out with like a lower high or a head and shoulders formation? Or does it just need to swing up and start to move lower? It all depends on the context. So the answer is different every single time. So when I talk about my visions, like today, I had a vision for move higher. Let's talk about that. For the E-mini S&P. And just got to find it. So I tweet this stuff, by the way, guys, on Twitter and also on StockTwits. So here is the ES. This is the vision that I had. Support down here. Now, the reason is very simple. And I made it very clear. Whilst the market could sell off, my Twitter is at L2ST. Oops, sorry. At L2ST. So what we have is an area where I don't really want to sell. I know I don't want to short. What the worst situation you can get into, the market's selling off massively, you just jump in because you think, oh, wait a minute, this is a high momentum move. The market's really cracking lower. This has got to be a breakout. That's like the worst thing you can do. You either have to focus on the longs there or you focus on the short. You can't do both. You don't want to be in a situation where you're long thinking, maybe I want to be long, maybe I don't, maybe I should be short. You know, and then people wonder, why do they develop doubt, fear, and anxiety? You know, if you're already thinking long and short, of course you're going to have doubt, fear, and anxiety. You know, I couldn't care less if this market makes the biggest move lower that it's ever seen. I said that today in my live mentorship room. I know I'm focusing on longs. I'm waiting for sellers to get trapped. I'm waiting for that opportunity, right? That's all I'm interested in. Does that mean it's going to come our way or not? I don't know. But the thing is, if it does, at least I've done all I can to find belief and confidence. At least I've only committed to a trade that I actually believed in. I had confidence in. You know, so then after all of your analysis, your patience, your discipline, if it doesn't work out, it is much easier to accept because you can put your hand up and say, look, I've done all I could. It just didn't work out. That was like my first trade today on the Euro stocks. So I'll just show you guys that in a little while, actually. So look at the E-mini S&P here now. Just talk about the trade that we covered in the room. Just give me a second. All right, sorry guys, I just turned the screen sharing off by accident there. Should be back now. So here's the E-mini S&P testing unfair lows, but I know I'm focusing on the long side. Whilst on the 60-minute chart there, it looks like it's moving lower. Yes, it did, but there was a nice rejection lower too. And I'm focusing on the long side. I don't care. You know, that's below value. So if you look at the E-mini S&P intraday now, this is what I covered in the room. This was the long, and we waited until these lows are put in because it's a massive move down. It's like over a 20-point move down. But just because it was a big move down doesn't mean it had to be the opportunity. There will be moves in the market that are not opportunity for you. They're opportunity for somebody else. So what I often say is I say, look, yes, it's moving lower. It's none of my business. It's not in my business plan. It's not in my trading plan. I don't care where it goes. I'm not looking to short. I'm looking for longs. You know, there does come points in time where you switch from long to shorts and shorts to longs, but I'm not going to go into that right now. Okay. For the majority, you need to focus on a certain situation, specialize. Are you going to be a buyer that day or a seller that day? Because you need to find your belief and confidence. You need to find your discipline. You need to find your patience. You know, I covered a long here earlier on today, hit a good few targets, but then it set up again later on. I explained also that you wouldn't need to take that again, but you know, that failed in the end. The Euro stocks earlier today, you know, yesterday was a good trade for me. Today was a different day. I had a similar kind of idea, but one day is just a dot on the screen, guys. It doesn't mean anything. You know, what is happening consistently following your approach? That's all that matters. And are you really finding belief and confidence in what you are doing? Are you really truly believing in the ideas that you are trading? Are they really grade A trades, or are you just trading willy-nilly, trading anything and everything, just hoping that something plays off? Because a lot of people are. They just don't admit it to themselves. And that's what, you know, I want to sort of leave open today. You know, what are you doing? What is your plan? Are you very specific? You know, do you need more structure? You know, that's why me and Tom exist. You know, we're here to help you guys. We can hopefully provide some answers. You know, obviously we can't do it in a 2-hour webinar between two of us today, because we've only got a very short period of time, but it gives you an insight into our mindset, our way of thinking. So, you know, that's what I really wanted to sort of see if, you know, this can really sort of hit home for people. And what I'm going to do with that, I'm going to end this and I'm going to just share my contact details. My email address is info@thetradingframework.com. And my website is www.thetradingframework.com. Please go ahead. If you haven't already done so, just sign up for there's a 5-part training series there. It's free. Just put your email address, your name in, and you're getting more of an insight into the technicals and the stuff that, you know, I believe in and why it makes sense, etc. And I'm sure Tom will be able to point you in the right direction as well. So Tom is not in my room. I've not been in his room either, but it's not what it's about. You know, the point here is that, you know, we're two different traders. We have a very similar sort of walk of life in a way. We're very similar age. We have a similar kind of background. We have a like mind. We are like-minded. You know, we both trade the Bund, we both trade the currencies, etc. So I wanted to bring us both together, but I don't want it to sound like I know the answers or Tom knows the answers. I want you guys to sort of be able to listen to both of us and learn from both of us. I want you all to really sort of understand this is not just about technicals. It's about mindset. It's about process. It's really about building belief and confidence. And true belief and confidence, not bullshit belief and confidence. You know, do you truly believe in your plan? Do you really understand why it makes sense? Because if you don't, you need to take some time to make sure it does. Right? So on that note, I'm going to pass it over to Tom quickly whilst I take a quick breather and see if you've got any comments, Tom, or anything like that. If you want to just share your screens or anything or your contact details.
Hi guys.
There we are, Tom. Sorry, I just passed over the controls.
Okay, great. Let me just share my screen. Now it wants to put me, hold on 1 second. It wants to put me over here, so I'm going to share that. No, what am I sharing? I can't actually see what I'm sharing. Hopefully it's market profile. It is the market profile. It's not the porn film that's playing on the other monitor. No, I'm only kidding. Okay, good. So, I mean, has anyone got any questions that they wanted to put to me? I mean, I've really enjoyed that presentation, Cam. Really, really enjoyed it. And it highlighted what you said, which is that we do have very, very different, very similar way of approaching the markets. We have different techniques for engaging with different things that we look at, but the process is similar, and that's really important. To show my contact details. Yeah, that's the part that I forgot. So wrapped up in talking, I forgot to share my contact details. So what I'm going to do is I'm going to type them on the screen. Well, no, I'm going to actually type them in the chat box. Okay, so that's my Twitter handle. And I spend a lot of time on Twitter, so that's the best way to actually get hold of me. If you want my email address, I don't know why I haven't got an @ sign on my PC here. Okay, this is good. That's my website, and my email address is that, but obviously with an @ sign rather than at. Would have been nice if I put that in a nice little presentation, but hey. I was talking, incidentally, was my screen still being shared? Okay. Okay, fine. I said a couple of things in the webinar, and I couldn't find the chart for them at the time, and I just wanted to quickly show you what those things were now while I've found my charts. I was talking about a setup in the DAX, which is here. Now the market makes a big move down and it breaks these lows, and it's one of my swing failure patterns. And what I was just briefly talking about is just risk reward on a trade. A level like that, even if I was thinking about going long, I'm aware of prior structure. So I'm aware that we've closed through the lows, but these are the first areas that are likely to see offers on the way up as the sellers have seen it break, and they're going to be looking to potentially get on board. So in situations like that, I would like a free run. I'd like to know that the first areas of prior structure where sellers might join it is away from market. So if I get long, I've got some room to go to, as it were. And the other thing that I wanted to just quickly show you was I've got an area, and my area in the Bund that I was looking at is on the market profile. I was just talking about this over here. You will see, if you look over here at 53.73s, we've got an old weekly volume value area high, and we've still got some these are naked single prints. They haven't actually been tested yet. So basically on this week where we broke from the balanced period here to imbalance, and we left that volume value area high there, and that is coming in at today's low. That's basically where we've come in, where we tagged. So earlier we sold off quite, and you see again, it's all plotted. I plot this all ahead of time. So you'll see down here, I've actually written the week, marked it all up on the chart, what it was. And then as we come into that area, look how aggressively we come down into that area, very, very violently. And we tag it beautifully. And then we just, we bounce up over. So there was a trade there, but obviously I was about to steam into a webinar, so I didn't take it. So you lot have cost me money, basically. Thanks a lot. I'm only kidding. I'm only kidding.
Hey, Tom.
Yeah.
I appreciate that. Can you hear me?
Yep, I can.
Okay, brilliant. So, Tom, I really appreciate what you did today. I'm sure everybody learned lots from this, and it's been recorded, so you guys will get the recording. What we're going to finish it up there. I've just put Tom's details in, his Twitter handle, his website, my website, and my email address I just shared. So, please, get in touch if you have any more questions. Of course, we'd love to sit here and take questions from everyone here, but we just, don't have the time. So, thank you very much for joining in. I really apologize for the technical difficulty that we had earlier. I hope we've made it worth your while. It's always, it's at least my job, and I'm sure same for Tom, to provide as much value as possible. The reason I do this is really to sort of give back, really provide what I would have liked myself. I would have liked these kind of answers myself, and I want people to understand that, that's why we do it. We don't have to do this. We do this. We put our time and effort into this because we love it. We have a passion for it. But at the same time, I know it just sounds a bit corny, but really, it is to help you guys. And that's really what it's about. You believe us or you don't. But, take of it, make of it what you will. But hopefully we're giving you some guidance, and somewhere along the line, you recognize that we provided some insights. So Tom, I think that's pretty much it. You done there?
Okay, yeah, I'm done. Thanks again, guys, for coming. Really appreciate it. Had a great time, and I've learned something as well from you, Cam. So I'm very happy all around, mate.
Good stuff. I've learned from you as well. That's the thing. We never stop learning, and we should always, remain an open book. Never become that full cup, because you can always learn something.
Yep.
All right. Take care, guys.
Cheers, guys.
Tom. Take care, mate. Thank you very much.
Cheers. Bye.